Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss alternative investments. Specifically, I'm going to chat about the two main kinds of alternative investments, the three most common types of private investments, how these can fit into a retirement portfolio, the risks involved, who's a good candidate to utilize private investments, and lastly, as always, a few action items for you to consider. So, at their core, there are two main types of alternative investments. First are private assets, such as private equity, private credit, and private real estate. They are more complex and less frequently traded than public stocks and bonds, and give investors access to additional sources of diversification and return. Hedge funds, the second type of alternative investment, operate mainly in public markets, but use less traditional tools such as short selling and leverage. Now, there are many other types of alternative investments like cryptocurrencies, collectibles, art, and structured products, but I won't be covering those today. Rather, I will be discussing the first alternative type I mentioned, private assets, which include private equity, private credit, and private real estate. Now, over the last few years, you've likely started to hear more and more about this kind of investment and the potential value it can add to your retirement accounts. Now, although this kind of investing may sound new to you, the fact is that pension funds like the Canadian Pension Plan, large institutions, and endowment funds like Yale and Harvard have been using these types of assets for decades. So, spoiler alert, if you have been contributing to the Canadian Pension Plan, then you've already been investing in alternative investments without even knowing it. So why are these institutions and pension funds using alternative investments? Well, there are four core reasons. First is diversification. This is where different asset classes with different investment and risk profiles result in lower risk when combined in a portfolio. The second is low correlation. So with the growth of ETFs, we've been seeing a big uptick in fixed income and equity correlation. Alternatives have a low to zero correlation with equity markets and traditional fixed income options that can lead to a more efficient portfolio. Third is reduced drawdowns. Low or uncorrelated assets will perform differently at different times. Alternatives perform more consistently with lower volatility, protecting portfolios from large drawdowns or losses. Number 4 is more attractive risk-adjusted returns. With lower volatility than fixed income and equity, but higher income streams, alternatives may provide better risk-adjusted returns. So let's break down each of the three alternative private investments and their potential fit in a retirement portfolio, their benefits and drawbacks, and lastly, who's a good candidate to add these kinds of investments to their portfolio. Okay, so first off is private equity. While retirement investors gain equity in a business by buying its shares on a stock exchange, they can also gain equity in a private business outside of the stock exchange. This is called private equity. Now, by investing in private equity, investors can access a wide field of investment opportunities not typically offered in public markets. So, why is this important? Well, for every publicly traded company, there are more than 6,700 private businesses. So, rather than competing for the same 1,500 stocks as everyone else, private equity may help you gain access to be a shareholder of a private business. Now, as I mentioned before, the Canadian Pension Plan has a significant allocation in private investments, specifically private equity. In the 2022 annual report, it was disclosed that the CPP had allocation of 32% in private equity, which has a higher allocation than the public market holdings in the portfolio. So, where does private equity fit within a portfolio? Adding this allocation can be a viable complement to a traditional stock and other asset classes in a growth-oriented investment portfolio. When used appropriately, private equity can diversify the overall risk-return profile of an investment portfolio. I encourage you to work with your advisor on deciding the optimal allocation of private equity within your portfolio based on your investment goals, risk tolerance, and objectives. Next up is private credit. This asset class is broadly defined as negotiated loans that take place outside of the traditional bank network and are held by private companies. Being able to provide investors with more senior secured positions in the capital stack has made private lending an attractive option for portfolio diversification. With the tightening of bank balance sheets, private credit has started to become a more critical part of the lending system. As an investor in private credit, you may position yourself to benefit from the rise in rates paid by borrowers. So, where does private credit fit within a portfolio? Well, this private asset can serve as a viable complement to a range of investment portfolios. When used appropriately, private credit can diversify the overall risk-return profile of a retirement portfolio. It may be used to complement other fixed income and bond holdings to create a more robust fixed income asset allocation. Again, work with an advisor when deciding the optimal allocation of private credit within your portfolio based on your investment goals, risk tolerance, and objectives. Lastly is private real estate. Private real estate offerings come in a variety of strategies and structures and typically involve income-generating properties such as residential, storage, student housing, and industrial buildings. These investments can offer investors a range of benefits such as capital growth, stable cash flows, and access to select real estate opportunities that are not available otherwise. In a way, this kind of investment allows you to own a piece of various kinds of physical real estate and benefit from the rental income and appreciation of the underlying properties. So, where does private real estate fit within a retirement portfolio? Well, this asset can be a viable complement to publicly traded securities in different investment portfolios, ranging from income-orientated to growth-orientated. When used appropriately, private real estate can diversify the overall risk-return profile of a retirement portfolio. Please work with a professional to help guide you in deciding the optimal allocation to private real estate based on your investment goals, risk tolerance, and objectives. All three asset allocations I just discussed, private equity, private credit, and private real estate, the key takeaway here is that these kinds of holdings are meant to complement a traditional portfolio by adding greater diversification, lower correlation, and provide a better overall risk-adjusted rate of return. To put this in simple terms for a retirement investor, adding alternative investments to a retirement portfolio may decrease the swings in your portfolio, reduce drawdowns, and create more consistent income streams for an overall more satisfying investor experience. As an investment advisor, I have seen firsthand how adding these kinds of investments can add value to an overall retirement portfolio. But hey, in life, there are always going to be risks, and investing in private assets is no different. Here are a few key considerations. First is concentration risk. In English, are all your eggs in one basket? If you're a seasoned investor, you may own or have been offered private investments. Some exempt market dealers structure these kinds of private investments that allow individual accredited investors to buy into things like car washes, real estate, and student housing, which, yes, these are private assets. But do you really want all of your money in one car wash or a student housing complex? Just like you wouldn't want to put all of your money into a single stock, you don't want to put all of your money into a single private asset, like a car wash. To address this concentration risk, look for a provider that utilizes a sub-advisor model that will add diversification within each of the private asset classes. We call this the Accessible Multi-Manager Private Securities, or AMPS, AMMPS. AMPS uses our best-in-class thinking to uniquely structure pools of private securities using an institutional approach. That means using the risk analysis, composition, approach, and structure to create a product that amplifies these features. The second consideration is due diligence. In the public markets, all information on a company is just that, public. You or I could easily Google a publicly traded company and search for their most recent financial statements. The same cannot be said for private companies. If you are considering these types of assets, please complete your own due diligence, and furthermore, work with the team that utilizes a comprehensive due diligence process through the investment lifecycle. These are crucial safeguards that need to be in place to help protect the investor. The third consideration is liquidity. This refers to the ease with which an asset or security can be quickly bought or sold at a fair market price. Private investments are less liquid than securities that are traded on public markets. This is due to the long-term nature of these investments and the lack of secondary markets. To you, the retirement investor, this speaks to the importance of creating a retirement income withdrawal strategy that takes into account how the retirement portfolio is invested. The last consideration is access. In order to access these kinds of investments, you will need to be an accredited investor. To qualify as an accredited investor, you must have a personal income of over $200,000 or a household income over $300,000 for 2 consecutive years, or $5 million in net assets, or $1 million in financial assets. This last point leads me to the one question that I want to answer for you. Who is a candidate to add these kinds of investments into their retirement portfolio? First and foremost, as with any investment, your risk tolerance, risk capacity, and timeline are the key components that need to be factored into any investment decision. With that, adding private investments into a well-balanced portfolio is suitable for nearly all investors. If you aren't an accredited investor, there is a solution out there that can help you gain access. This solution is called pension-style investing. This option utilizes private assets in combination with traditional investments that are accessible to accredited and non-accredited investors alike. You can learn more about this investment approach by listening to episode 16 of the podcast or by visiting our website. And there you have it, your brief introduction to the world of alternative investing. Now, for your action items from today's episode. First, explore your options. With the sharp rise in interest rates we've been seeing, retirement investors watched as their traditional portfolio of publicly traded companies and fixed income both had negative returns. This prompted many to start exploring their options to diversify a portion of their portfolio for years to come. You should do the same. Lastly, know what you're getting yourself into. Be sure to do your own due diligence and work with a team that has an internal safeguard setup and process that continuously monitors your portfolio throughout the investment lifecycle. Okay, so there you have it for today's episode. For all the links and resources, please check out the show notes or visit retiringcanada.ca. If you've been listening to the show for a while and you've been enjoying some of the content that I've been putting out, I'd really encourage you and appreciate a 5-star review on your favorite podcast app. It really helps getting the message out. If you're enjoying this, please join the weekly Retiring Canada newsletter. You can find that link in the show notes. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.